There's a retirement account that lets a self-employed person, a freelancer, a contractor, anyone with a side income stream, shelter up to $69,000 a year from the IRS, completely legally, and your bank, your HR department, and every financial literacy class you ever sat through will never tell you it exists. That number is not a typo. $69,000 in one account, in 1 year. Most people think the retirement savings game goes like this. Contribute $7,000 to an IRA if you're lucky enough to qualify, maybe hit the $23,000 cap on your employer's 401k and call it a year. That's the ceiling most people are handed. And the IRS takes everything above that threshold, 22%, 24%, 32%, depending on your bracket. That's just the cost of earning money. That's what school taught. That's what HR confirmed, so you believed it. But here's the thing, there is another door, and it's been open the whole time. It's called the solo 401k. Some people call it the individual 401k or the self-employed 401k. The name changes depending on who's talking. The power doesn't. The solo 401k is a retirement account built specifically for people who work for themselves, even part-time. If you have any self-employment income at all, a freelance gig, a consulting side hustle, a small business you run on weekends, you are likely eligible. The only requirement is that you have no full-time employees other than a spouse. That's it. That's the gate. And here's where it gets interesting. Inside a standard employer 401k, you're an employee. You contribute as an employee up to $23,000. Your employer might match a percentage. That's your lane. You stay in it. In a solo 401k, you play both sides of the table. You are the employee and the employer. So you contribute $23,000 as the employee. Then you contribute up to 25% of your net self-employment income on the employer side. Those two buckets stack, all the way up to $69,000 in 2024. If you're 50 or older, that number climbs to $76,500. Here's a real number to make it land. Say you net $150,000 from self-employment. You put in $23,000 as the employee contribution. Then you add $37,500 on the employer side, 25% of your net. That's $60,500, tax-deferred in a single year, gone from your taxable income. If you're in the 32% bracket, that's $19,360 in federal taxes you just legally didn't pay. Not avoided, not deferred indefinitely. Legally redirected into your own retirement account instead of the Treasury. That's not a loophole, that's the tax code working exactly as written. Wealthy business owners and high-earning consultants who work with the right CPAs have known this for decades. You probably weren't told because you weren't supposed to need it. The financial system is built around employees. You get a 401k offered by your company. You contribute what HR tells you the limit is, and a brokerage somewhere earns fees off your balance for the next 30 years. The solo 401k lives entirely outside that pipeline. There's no payroll department to offer it, no employer to explain it. It falls through the cracks, not by accident, but because the cracks are very convenient for everyone except you. And this isn't even the best part. The solo 401k can hold a Roth option, meaning you can make after-tax contributions to the employee side and let that money grow completely tax-free. No income limits blocking you out the way a standard Roth IRA would. High earners get priced out of a Roth IRA at $161,000 in income. The solo 401k has no such ceiling on the Roth side. You earn more, you still qualify. Now the catch, and there is one. You need self-employment income to qualify. A W-2 only employee cannot open one. You also need to open the account by December 31st of the tax year you want to use it for. That deadline is firm. And if you ever hire a full-time employee who isn't your spouse, the account structure changes and you'll need to revisit your setup with a CPA. But for the tens of millions of Americans who freelance, consult, or run any kind of independent income stream, this account is sitting right there. Open, legal, largely unused, because no one teaches this in school, not in economics class, not in the one financial literacy module your guidance counselor rushed through. Not in the HR onboarding packet at any job you've ever held. The question isn't whether you could have been using this for years. You already know the answer to that. The real question is, what else are they not telling you? Because there's a strategy that pairs directly with the solo 401k. One that lets the money sitting inside it generate liquidity without triggering a single dollar in taxes or penalties. That's the next file.